Hi, everyone. Thank you for joining today's session. I know it's a catchy tagline to see if the market is crashing or not. And we are very fortunate to have with us Nigel D'Souza, who is one of the most sought after people in the Toronto space as far as investment is concerned. Nigel is an investment analyst at Veritas Investment Research, and his coverage includes banks, insurance, but pretty much most of the market would listen to what Nigel has to say about market overall. He has been recognized as the Refinitiv Starmine's top stock picker. And so when he says something is a buy or a sell, people would follow that. He's also one of the leaders at RMA Toronto, a global nonprofit for advocating risk management issues in financial services. And therefore, he's dedicated to risk management across a spectrum of financial service institutions in Canada. I'm Khushbu Jha. I'm the founder of Buy Properly, a platform for fractional investing in real estate. And what we allow is for people to be able to buy small fractions of real estate properties and assets through a completely online, frictionless platform. So you go online, click, choose, click buy, check out, and you are a proud owner of an investment property. And from there on, you obviously get dividends once a quarter. And after 5 years, you exit with capital gains. That said, it's an honor to have Nigel and hear his views on how the market is evolving. But before we get into that, maybe we do a quick check on what the audience is really thinking at the moment. So let me try and hang on. Okay. Let's see if I can get people to answer just the basic question so that we are all on the same page, because we would want to get a sense of where people are. Nigel, while you wait for this, I'm guessing for everybody, top of mind is what is fresh off the press, the 100 basis point hike. And so maybe we could cover that as part of today's session. But the intention is to make sure everybody, okay, we have a lot more sophisticated and good knowledge people. So the intention would be to do a quick overview of what is the definition of a market crash, because people talk about it in layman terms, the market is crashing, and then get into what you see of the current macroeconomic environment and the Bank of Canada's rate before we get into real estate specific.
Sure, yeah, thanks for having me on, because I think the most important market dynamic to get right now is the outlook for interest rates. And last year at our housing conference, which we host annually in October, we outlined a scenario and a risk of a rapid normalization of interest rates. And at the time, we were pointing out elevated inflation being a concern. But what was unique is that when we looked at expectations for interest rates, the bond market was expecting a significant increase in interest rates this year, which has played out. But a lot of investors, including equity investors, were expecting very few interest rate increases. For the most part, equity investors were expecting interest rates to rise or increase by less than 2% in 2022. And you know, heading into 2022, there were even a lot of investors and equity participants that didn't expect interest rates to rise more than, you know, 1/4 or 0.5%. So we've come a long way. We've already had 2% increase in interest rates, but more interest rate hikes remaining. And now the question isn't, well, are we going to have interest rates continue to move up? It's a question of where do interest rates plateau, and then what happens after that. So right now, based on fixed income markets and bond markets, futures pricing implies an expectation for the Bank of Canada policy rate to finish 2022 at around 4%. So the policy rate is 2.5% currently. And the fixed income markets are expecting it to hit 4% by the end of this year. So that means there's another 1.5 or 150 basis points of interest rate increases that are baked into the bond market. And next year is actually interesting, where the fixed income market is expecting interest rates to actually go down. So the fixed income market is expecting the Bank of Canada to start cutting interest rates next year. And that's due to an expectation for higher rates to result in a recession or have negative impacts to financial markets and the broader economy. So your outlook for a lot of asset classes and sectors like banking is highly dependent on your outlook for interest rates and what do you think is going to happen, whether the fixed income market is right or whether it's wrong and interest rates are going to actually peak at a much lower level and maybe decline at a much faster pace next year.
So that's a very good overview to also know that it's going to decline in a few quarters, but it's bad to know that it can go up to almost 150 basis points in the next few quarters. Maybe we get everybody on the same page. How are we defining recession? There's talks of us being in recession already. And I don't know if we are officially in a recession. So what's an official recession? And
Sure.
How will that connect to the interest rate?
Sure. So when we talk about recession, there's multiple ways to define it. The technical definition of a recession is 2 consecutive quarters of negative GDP growth. So it's very likely that we're going to enter a technical recession of 2 consecutive quarters of negative real GDP growth. So that's GDP growth after adjusting for the impact of inflation, which is, again, very important. So keep in mind, if you go back to the 1970s, when we had inflation running really high, and we had recessions in the 70s, nominally GDP, which is the actual dollar amount of GDP, was actually positive. The problem was that inflation was greater than the increase in GDP. So real GDP, which is nominal minus the rate of inflation, was negative. And what the market cares about and what policymakers care about is real GDP, because you want the actual output to be increasing. You don't want output to be increasing simply because things are more expensive. Now, in terms of how do we define a recession, there's a technical definition, but there's a broader definition as well, which is one that the NBER uses, which is the US department that labels recessions. And that requires multiple variables or factors to decline, including employment. So in other words, if we get a recession just because of GDP growth being negative for 2 quarters, but unemployment remains low, then that technically is not a broad recession. That's simply a reduction in output. And it may not be labeled a recession, and that could possibly be what the Bank of Canada refers to as a soft landing, which is the outcome that the Bank of Canada prefers to occur with rates going up. But there's another interesting dynamic at play here, which is the impact of COVID-19. And because of COVID-19, a lot of individuals are on disability or unable to participate in the workforce. So labor force participation is declining. And the Bank of England actually pointed out to the impact of long COVID, which is COVID illness that persists for many months, reducing the rate of labor force participation, which artificially lowers the unemployment rate. So we could have a unique dynamic where, because of people being too sick to work, the unemployment rate is heading lower, even though the economy is not doing well. And in fact, if you look at the most recent unemployment numbers for Canada, the job numbers wasn't good. But the reason why unemployment declined is because the amount of people that left the labor force were greater than the loss of jobs in the last report. So the unemployment rate actually went down. So we're in a very unique environment where we could have the economy measured by GDP shrinking, but unemployment remaining strong. And to me, that only supports the central bank and the Bank of Canada's motivation to keep raising interest rates, because if unemployment stays strong and inflation is still high, then the Bank of Canada has enough political support to continue to raise rates.
So just to double click on what you just talked about, on how the GDP may be shrinking, but unemployment is still holding strong. And for Canada, that's not because everybody has jobs and nobody lost jobs in COVID and nothing changed and everything is all hunky-dory. It's because there are less people wanting to look for jobs.
Wanting or able to because they're sick. Yeah.
Now, is that somewhere going to factor in somebody's thinking to say, hey, the overall workforce that could be employed in Canada is smaller than it used to be, or that would not impact the policy decision?
It would definitely impact the policy decision because it could be a structural shift in the labor market, right? If the supply of labor is lowered structurally because of COVID-19 resulting in elevated levels of illness and insurance companies call that morbidity. But if that's happening where people are just simply too sick to work because of continual reinfections from COVID or COVID variants, then that means we're going to structurally be undersupplied on labor, which is again supportive of wage price inflation. And if you have wage inflation, that can feed into price inflation. And that's what's called the wage price spiral, which is what happened in the 70s. And that's what central bankers want to avoid. So we could have a structural effect here where due to labor supply shortage, wages move up, which only increases the risk of inflation staying elevated. And that in turn will force policymakers like central banks to not only increase interest rates, but to keep interest rates at a higher level for a sustained period of time, which is important because it's not just about interest rates going up, it's about how long do interest rates stay elevated. Because if it goes up quickly, then falls quickly, the impact is not as negative as if it goes up and remains elevated or at a higher level for a sustained period of time.
Sometime back, you talked about how the bond markets are assuming that the interest rate will go up another 150 basis points and then actually start declining. I'm assuming, obviously, the market is factoring in the structural change, or would you think that it may or may not factor in all of the structural shifts in workforce for a place like Canada? And then just to impact that whole structural aspect, obviously Canada is offering to bring in more immigrants from Ukraine and other places, and trying to increase the overall workforce size on one end. Does that factor into these markets, or is it usually a lag that it will show up, that there's been structural changes? What's your take on that?
Sure. So the pricing for the bond market is very short-term focused. It only looks out maybe 12 to 24 months. It doesn't really look out longer than the next 1 or 2 years. So it's more reacting to recent inflation data. So we saw inflation numbers come out recently for the US. They were higher than expected across the board, indicating that inflation is going to remain sticky. You're seeing structurally elevated inflation in things like rent prices. So the bond market is reacting to recent inflation data, not structural, secular or long-term trends. The structural impacts that I outlined are going to affect the outlook for the next 10 years, not necessarily the outlook for the next year or two. And it's something that even central bankers have pointed out. We've had, Jerome Powell, the head of the Federal Reserve, state that we may never go back to the environment that was pre-pandemic in terms of low levels of inflation. And that's because we could be entering a period of deglobalization, right? Globalization over the last 20 years resulted in developing markets being able to access cheaper labor, cheaper sources of production, more efficient supply chains. All that reduced the cost of goods in the economy. But with political risk, you've seen it with Russia-Ukraine conflict, we've seen it with China and the zero COVID policy and potential China also having military conflict in Asia. All of that's resulted in Western economies now nearshoring, onshoring their production and supply chain, and also maybe going from a just-in-time inventory to actually building up excess inventory so they can manage it better. So in other words, you could have supply chains becoming less efficient and more expensive, and that's going to result in inflation being a lot stickier. So we could have a higher inflation, higher rate environment. Another aspect is climate change. Right? Climate change is disruptive for energy markets, and we could have structural issues in oil and gas. Oil and gas has been underinvested in. So energy prices are elevated, and they're likely to remain elevated simply because you can't flip a switch and start producing more oil tomorrow. It takes years of investment and work to build out the production capacity for the energy sector. So until we get, cheaper alternative energy sources that are cleaner, we could have energy also that remains elevated. And then lastly, you have potential for food and commodity prices to remain elevated. You're seeing a lot of countries trying to nationalize their resources. So Indonesia, for example, I see the Indonesia and Malaysia, they banned the export of cooking oil, which is incredibly important for the global economy, especially developing world. You're seeing countries ban exports of wheat. I think India banned export of wheat, and they're a major wheat exporter or a grain exporter. So you're seeing the supply shortages occur even in the food markets, and that could lead to food prices remaining elevated. So, and then on top of that, you have elevated input costs related to fertilizers or other commodities that feed into farming, right? So we have these structural long-term issues that could result in us being persistently in a higher inflation, higher rate environment. That doesn't necessarily mean, something like the 1970s or 80s where interest rates 18%, but maybe it means inflation, instead of being 2%, is 4% on average. And instead of interest rates being around 1 to 2%, they're around 4 to 5%, right? So that may be how we have to think about the economy looking forward.
That's a lot of food for thought for all of our audience. Let me do a quick check on what's the mental state of people right now joining this call. Most of them have indicated they are on the higher side as far as knowledge is concerned. So let's see where the investing environment thinking is. And we have two questions, Nigel. If you just go to the question and answer section,
Sure.
One of them, I think you addressed, saying, how can there be a recession and interest rate going up? Don't understand. So that's kind of what you explained. But there's a second one where I think somebody is asking you to take a stand on what do you think? Do you think the interest rates will go up and stay, or do you think it will drop and come back down?
Yeah, no, good question. I think the first part of that question is to ask, well, where do you think interest rates will peak? Right, that's important. Where does it peak first, and then how long does it stay up? Now, when we look at it historically, whenever central banks have had to try to deal with elevated inflation, the central bank policy rate has always had to increase to above the rate of inflation. So if you look at 2006, 2007, which was before the financial crisis, inflation was running elevated. It was above 2%. And the central banks had to raise the policy rate closer to 5% in order to deal with an overheating economy. Now, the issue today is that we have inflation that's running at a 30-year, 40-year high in some cases. Now, the Bank of Canada does expect the rate of inflation to come down, but to still remain above 2%, somewhere around 4% in 2023. So if the Bank of Canada is right on their own forecast and inflation is going to be around 4% even next year, then the Bank of Canada policy rate has to at least be 4%. And that's what the fixed income market is saying. It's saying 4%, but 4% only matches the rate of inflation. So I think it's actually more likely that the risk is skewed to the upside, that we could see the Bank of Canada raise the policy rate at least 100 basis points above the rate of inflation, which means 5%, 5 to 6%. So I think the peak policy rate will actually be 5 to 6% sometime next year, maybe even in the middle of next year. And then do we get interest rate cuts or not? And that's a very interesting question. If you look back to the 70s, even during the 70s, the central bankers at the time cut interest rates due to a recession. There's a central banker named Arthur Burns in the early 70s in the US that cut interest rates in the early 70s when the economy slowed, even though inflation was running high. So inflation was running high, they're entering a recession, he cut interest rates. But the problem with cutting interest rates is that it resulted in inflation staying high for the rest of the decade. And then another central banker called Paul Volcker had to come in, and he had to raise interest rates to well above 10%, and keep them there for a long period of time in order to deal with inflation. So this time around, a lot of the central bankers are aware of that policy mistake in the 70s. And that's why you're seeing the Bank of Canada, quote unquote, front load interest rates, because they're trying to get ahead of that. And what they're going to try to do is they're going to raise interest rates a lot in the short term, maybe get to 5 to 6%, because they are really worried about not raising interest rates enough, and then inflation becoming unanchored, increasing and staying elevated like it was in the 70s, and then needing to raise interest rates even more to closer to 10%. That would be the worst case scenario for the Bank of Canada. Now, whether or not they cut, I think it comes down to political dynamics. So it comes down to when will it be politically acceptable for the Bank of Canada to cut interest rates? And in my view, it won't be politically acceptable unless the damage to the economy is so severe that even if inflation is still above 2%, no one is going to criticize the Bank of Canada for cutting interest rates. So unfortunately, what does that mean? That means you need the economy to enter a very severe recession, something similar to what happened in 2008, 2009, for central bankers to say, okay, the economy is declining at such a rapid and severe rate that even if inflation is above 2%, we can stop raising interest rates and we should probably cut interest rates. So, it's a bit of a lose-lose, because either we get higher interest rates or the economy gets hurt so badly that they have to cut. So I don't think either outcome is positive. The only question is, how do we get there?
So talking about interest rates, so it looks like there are two scenarios. Interest rate goes up and then maybe it comes down a little, but there'll be no rush to bring it down. Or the interest rate goes up and up because the economy isn't doing that badly, so there's no rush to reduce the interest rates. What does that mean in terms of housing prices? Houses in Canada and definitely Toronto are not on an affordability scale. If we compare and we track these things at Buy Properly, on an average in Toronto, the average house price is about 14 to 15 times the average income. It is 5 times in New York and 7 to 8 times in San Francisco, which are two other big, large, growing and expensive cities. And yet, in terms of relative to income, house prices are already way more unaffordable. Now, if interest rate goes up, there are no cheap options. So what do you think is going to be the impact on housing prices, and how should people be thinking about the real estate market? Like, did we make a mistake buying $1 million house? But anyways, there was nothing available in less than $1 million for like the whole of GTA, right? So people who bought maybe in the last 6 months to a year, they probably bought $1 million house, and they probably bought in Oshawa or Milton and Hamilton, and not like city of Toronto, definitely not Oakville, which is probably selling for like 2 million or 3 million. And now if the interest rate goes up to 5% for Bank of Canada, you add another, if you have taken a loan from a TD or a RBC, you add another percentage because they've already done their hikes at 2.5. The TD is at 4.7, which means it's at 7-8% interest rate that we are talking about a mortgage of $1 million.
Yeah,
That's a very, very expensive mortgage. And if the income isn't going up, do we see the housing market, which has been going up for 20 years and everybody had forgotten that real estate is also cyclical, do we see that going down in a major way? Or do we think that just because there are so many people coming in, if I don't cuff up that crazy rate, somebody else will?
Yeah, I mean, it's a good question, and the answer is quite actually complicated and a lot of layers here. So I think the first step is to talk about the dynamics of interest rates and mortgage payments, right? And I think when it comes to housing, Canadians don't buy houses, they buy monthly mortgage payments. So ultimately, what matters to a Canadian investor or someone that's looking to buy a house to live in is, what's my monthly mortgage payment? And they try to maximize the property that they can purchase with that monthly mortgage payment in mind. And as you mentioned, the reason why higher real estate prices has not resulted in a destruction in demand is because low interest rates has enabled mortgage payments to remain relatively stable or increase at a much lower rate than the rate of real estate prices going up. Now, in terms of affordability, when we look at the affordability in terms of the amount of your income that has to go towards housing costs, when we looked at the data on mortgage rates, basically a 5% mortgage rate in terms of the percentage of income that goes towards housing, which is north of around 50% or greater. So a 5% mortgage rate already gets us to the prior unaffordability highs in the late 80s. So in other words, the amount of income that has to go towards housing costs has now risen to a level that last matches what happened in the 80s when we had a real estate correction in major markets in Canada. So we're already at the mortgage rate where affordability is a major issue. It doesn't have to go up any higher than here. Of course, if it goes up to 7 or 8% mortgage rates, that's even more of an issue in terms of monthly mortgage payments and affordability. Now, the question in terms of what happens to the real estate market. So what's happened initially so far is it's resulted in a reduction in demand. So you're seeing real estate sales decline across several markets in Canada. And that's from buyers, number one, not being able to afford the property at an elevated mortgage rate or qualify. But number two, it's also from buyers deciding to sit on the sidelines and wait to see what happens with the real estate market, because there's no rush to buy when interest rates are going up and when demand for housing is weak. But what we aren't seeing is sellers panic sell or have a very negative or bearish sentiment and trying to list properties. So listings have not gone up materially, but sales have come down materially. So we have active inventory or inventory in the market measured by active listings starting to move higher, but that's not because people are flooding the market with properties for sale. It's because the properties that are being listed, there isn't enough demand to absorb those new listings. So the question really comes down to, does sentiment shift from the people that already own these properties, either mainly investors? If we think about the source of supply that could hit the market, it would typically be someone that owns a rental property or multiple properties. The person that lives in their house is not going to want to sell their house unless they absolutely have to. So that's probably the last person to sell. It's probably going to be the investors or people that own rental properties that sell first. So the markets that have a higher portion of investment properties like North York or the York region in the GTA, or even in downtown core GTA in the condo market, any market that has a higher mix of investment properties is more likely to see an uptick in supply. But it hasn't happened yet. But it could happen if interest rates continue to move up and then remain elevated. Right now, everyone is holding on because they can. Because when interest rates are going up, the mortgage payment doesn't go up immediately. If you have a fixed rate mortgage, you have to wait till it renews for that mortgage payment to go up. Even if you have a variable rate mortgage, the payment is typically fixed and doesn't go up until renewal. It's only if interest rates go up to a certain level, which is called the trigger rate, that your monthly mortgage payment on a variable mortgage goes up before the renewal. So in other words, all that to say is everyone's monthly mortgage payment is not going up right now. A small portion are, but not everyone. But if interest rates remain elevated, then they will start going up over the next year or so. And that could force people to sell if they're cash flow negative, or if they're concerned that they won't be able to afford the higher mortgage rates, or if it becomes clear that the Bank of Canada is not going to cut interest rates anytime soon. So what happens with real estate prices is a lot trickier to say. What we can say right now is demand has come down. But the only thing that can really cause quote unquote real estate crash is if sellers panic and flood the market with listings, which hasn't happened yet.
Got it. Talking about investors, and since you're focused on investor products, and we at Buy Properly always talk about real estate investments. At our end, obviously, we want people to have a diversified portfolio. So our counter to the current residential market craziness is to see if we can add different kinds of asset classes. So we are not always in that mortgage issue situation. We are adding commercial, and we are also adding other geographies. So we have US, and we have other emerging markets that are also going to come in. But the stock market has its own problems right now. The crypto market is on a route. And like, if you are an investor and you are looking to put in money, the question is, and maybe we can ask the audience and how it goes. The question is, how are people deciding where to put the investment money? And in the early part of the webinar, obviously, some of the investors indicated they are ready to buy the dip. But where are they going to buy the dip? Is it the real estate that they should get into? Is it the stocks? And so maybe we ask what they are doing, but I would also want to get a sense, given that you cover a lot of the financial market, on where should they be investing? Should it be more stocks, bonds? Bonds are hot right now. Everybody wants mortgage because it is high returns and easy access and secure returns.
Sure. So this year has been a really bad year for investors. The traditional 40-60 equity fixed income portfolio has had its worst performance in history. The bond market has had its worst performance in multiple decades. And that has to do with interest rates going up. So there isn't an easy answer to where you can put money in. What I can say is that with interest rates going up, any asset class that's longer in duration is going to be negatively impacted, right? So what does longer duration asset class mean? It means any asset class where your returns are somewhere in the future, right? So tech stocks, crypto, anything that has higher risk that doesn't actually make money or generate cash flows today is something that's quote unquote long duration because you're paying for cash flows way out in the future. And when interest rates go up, those type of investments are worth less. So what will relatively perform better are any asset class or any asset class that is shorter in duration, so even shorter fixed income, or equity that generates a lot of free cash flow, and is not reliant on a lot of funding, like needing a lot of debt financing in order to operate the business. So anything that can just support itself with its own internally generated cash and reinvest is probably going to do better. Now, for real estate as an investment, it's about cap rates, right? As I'm sure you're aware. So what matters is the cap rates that individuals are willing to pay for real estate. And when you have rates going up, theoretically, investors should demand a higher cap rate, which essentially means investors are willing to pay a lower multiple on real estate. But the other dynamic is that cap rates are before your financing costs. So if financing costs are going up enough on the mortgage side, then even if people are willing to accept the cap rate currently, they're going to need more cash flow from that property or a lower price in order to be able to actually have some net money coming to the pocket, right? So it's a tough question to answer, but anything that's very interest rate sensitive, which includes the real estate, because, and again, the reason being is that real estate is not equity finance for the most part. It involves structural leverage, whether it's commercial or residential real estate. You have to typically get up to, you can do as high as sometimes over 80% of it can be financed. But typically at, around 75% will be financed with debt. So when you have 4-to-1 leverage as part of your structural capital in any asset class, when interest rates are going up, that's not good for that asset class, right? So any asset class that requires less debt financing, more equity financing, and generates a lot of free cash flow will do better. Any asset class where cash flows are somewhere in the future or has a significant amount of debt financing is probably going to struggle until interest rates stop going up and then potentially go down.
Got it. And obviously for us as a platform, to account for all of the macroeconomic changes, we are also changing our strategy and trying to move towards, if we are doing a pre-construction or a development or a value add project, then making sure we are going in only for projects that have a cap on the interest rate. So they have an arrangement or a line of credit that's fixed, which means how high the interest rate can go is capped. So we are not subjected to adverse interest rate scenarios, and that's true for both US and Canada. And obviously, suddenly what has become more attractive is, like you said, looking at properties that generate a lot of cash flow and trying to do an all equity deal rather than adding any kind of debt, because then you are kind of protecting yourself from all of the interest rate issues that might arise. Um, but of course, a lot of people do not use a wealth advisor, portfolio advisor, to include real estate in their portfolio, or thinking about it. So it's helpful to know, like you were saying, is like anything that has future cash flows will be valued less. But does that also mean that if you're an investor, you should go in and buy, or is that still considered high risk? Because you will
Well,
get a better value.
depends on the asset class, right? Depends on the asset class, depends on your time horizon, depends on the valuation of that asset, right? So that question is a good question, but it's very specific to the asset class, and not only the asset class, maybe the individual investment you're looking at. So I think really what we're in now is an environment where you can't be a passive investor. You can't look at asset classes broadly and say, I'm going to buy real estate, or I'm going to buy stock, or I'm going to buy bonds. You have to look at individual assets, like individual properties, individual companies, individual even bonds sometimes tied to a specific company, and evaluate it on an individual basis and understand the financial metrics and the dynamics of the risks involved in order to know whether it's a good investment. So we're entering a period where I don't think you can be a set it and forget it investor. You really need to be thoughtful and aware of the risks and the structure of the specific assets that or investments that you want to allocate capital to, because now we're entering a period where being a more active investor and being able to assess risks accurately is going to make a big difference on whether or not you're going to be happy with your investment, 5 to 10 years from today.
Got it. Yeah, and makes sense. And like for our side, obviously, one of the poll questions was, do you have a financial advisor? Do you look at people? How do you optimize your portfolio between stocks, bonds? And for most people, it was like, I haven't really optimized between stocks, bonds, and real estate. Like people tend to just put money towards real estate. It's a great hedge against inflation, but not in the context of how it fits in their investment setup alongside stocks. So we offer obviously portfolio management services if people are interested. But yeah, to your point, it has become way more about individual assets. In fact, we have seen some really good residential REITs going down, even though a lot of residential investments are doing reasonably well. But individual assets with fundamentals are definitely doing better than an overall portfolio.
Right, and I think there was a question about rent inflation as well. I think that's important. And when we look at, I'm sure I don't know if you've seen it, but
just
I'm sure
to read the question for the audience, it says, what happens to house rents in an inflationary environment when it's accompanied by recession and high unemployment levels?
Right. Yeah. So it's a good question. I mean, what you're currently seeing now is a lot of rental inflation. And if you saw the news on Manhattan, rents in Manhattan have hit, which is in New York City, have hit a record high, right? And even rental prices in the GTA are increasing at a fairly rapid pace. And I think a lot of that has to do with prospective homeowners moving to the rental market, and they want to wait out what's happening in real estate, right? Now, the thing about rents is that they can increase at a rapid pace, but there's an economic ceiling on rental market prices because there's a ceiling on income. At some point, people simply can't afford any more rent increases. So we are eventually going to get to a point where rent prices cannot go up anymore unless we get wage inflation. And we are getting wage inflation, but for example, the big 6 banks have raised the wages by 3%. That's still below the rate of inflation. So in real terms, people's wages are actually still going down. So until wage growth starts to be higher than the rate of inflation, you can't really have sustained increases in rental prices. And of course, if we have a recession where unemployment goes up, which again, we may not see because of the unique dynamic of people dropping out of the labor market. But unless unemployment goes up, and if unemployment does go up during a recession, then you would have a downward pressure on rental prices because vacancy rates would go up because there's fewer people that are making enough income to to be able to afford that rent, right? And ultimately, you're going to have, when vacancy rates go up, you're going to have rental prices come down. So I think in the short term, rent prices can continue to move up, and investors are definitely going to want to increase rents, because if their mortgage payments are going up, they need to have a higher rental income in order to pay for that mortgage. But ultimately, we're going to hit at some point a ceiling where you can't raise rents anymore. And that's when I think we hit another inflection point in the market, because at that point, either mortgage payments have to come down, or real estate prices have to come down, because rents have reached their economic ceiling. We're not there yet, but we're on the way.
Got it. Yeah, in talking about how people decide how to invest and how to think about it, honestly, this call has been very informative for me in terms of how the macroeconomics elements are playing out in the market, but just trying to understand how do other people figure out what to do with their money and how to invest. This is more me being curious on what do other people do than an actual buy property question. But maybe we can let some people ask questions, given that we have kind of covered most of the fundamentals. But before we get into that session, since we have you and you are an expert in the space, maybe we could outline some tips for investors in general on what they should be keeping in mind as they're thinking about their investment scenarios.
Sure. I mean, look, I think the first thing is you have to be aware of whether you are making a decision because you are in line with what the market expects, or you expect something different. So I think right now the critical variable is interest rates, right? And the outlook for interest rates. So I think the first question you should ask yourself when you're making an investment is, are you making this investment because you think that the market is wrong? And by that, I mean the fixed income market, the bond market, the interest rate futures markets, they're wrong in the expectations that rates are going to keep moving up to 4% or potentially more? Or are you making an investment assuming the market is right, and then making a decision of where's the best place to invest or how to allocate your capital if rates are going to continue to move up to 4% or higher? So I think that's the first question you have to ask. And if you're making a bet that interest rates aren't going to go up to 4% or higher, then you're basically saying you have some insights into the economy, interest rate policy, any sort of information that will enable you to make a better call than every other market participant, right? Now, me personally, I don't think I'm that smart. I don't even try to do that. I assume the market is right. So let's assume the market is right about rates moving up to 4% or greater. So if you want to make investments based on that decision, then you have to, like I said previously, you have to understand higher interest rates hurt a lot of asset classes, including tech stocks, anything that's higher risk, low quality, anything that's low quality. So anything that's below investment grade debt, for example, anything that employs higher leverage, all those are going to be hit pretty substantially when rates continue to move up. So you want to look at higher quality names, anything that is investment grade or higher. You want to look at stocks that, like I said, are very mature industries that aren't going to be exposed to rising interest rates, that have a lot of cash flow. Those are probably better in an environment of rising interest rates. Or you may even want to say, listen, I'm going to sidestep all of this risk. I'm going to move to cash, or I'm going to move to GICs where I get guaranteed returns. And that's actually what's happening in the marketplace right now, because for the first time in a long time, people can actually invest in a GIC and get a decent rate of return on their money. That hasn't really existed in the last 10 years. So if GIC rates are 5-6%, maybe that's more attractive to you than even putting money into stocks, right? So it's something that a person needs to think about deeply. If you have a financial advisor, speak to a financial advisor, because all of this is highly specific to an individual, and really try to make an informed decision. But I think the first question to ask is, what are you really betting on? Are you making decisions because you're assuming the market is right, or are you betting that the market is wrong? And if you're betting the market is wrong, that's a much tougher thing to get right as an individual investor.
Yeah, and it partially would also depend on what goals people have. in the near term. I mean, people who are renting and have been planning to buy a house can look at the rents rising and say, hey, I might just spend 40 grand on rent. And so if I just rent for 2 years, that's 80 grand flushed down. So I might as well just pay 80 grand extra for a property and own my own property. And that's one way of looking at it, knowing that or assuming that the interest rates would eventually be coming down or coming down. So it kind of also depends on their own personal circumstances, like you said, on what their individual financial goals are. But I think what I'm hearing is at the end of the day, it is all about fundamentals. And so you're looking at companies with strong fundamentals or assets with strong fundamentals, not necessarily trying to move up and ride a rising tide along with other boats, but saying, is it fundamentally adding value to the economy, adding value to the neighborhood, society, whichever way it is it fundamentally doing something that people are willing to pay additional for, or is just rising alongside others, is probably what I'm concluding.
Yeah, and also time horizon is important. Like whether you're going to hold an asset for 10 years versus holding it for 2 years is completely different decision-making process, right? And if you are a long-term investor, you have to think about whether it makes sense over the next 10 years. And in order to do that, you have to really look at the price that you're buying, right? Like the most important decision you make, I think, is the price you decide to purchase an asset at. No matter what the risks are, if you buy it at an appropriate price where the risks are already reflected in the price of that asset, you'll be happy with that decision. But if you buy it at a price where the risks aren't factored in, then you would be unhappy with that decision over the longer term. So I think it's really important to think carefully about the entry point that you have. And also you should probably stress test the outcomes. Like if interest rates go up, how does that impact your ability, if it's real estate, to pay for that asset class? And if interest rates don't go up or they go down, then how do you think that would impact you as well? So really think about different scenarios and think about the risks associated with them before you make a decision, because we're in a very volatile environment. Things have changed a lot in just 6 months. It could change a lot again in 6 months from now. So it's very difficult to predict where things are going to be, even just a year from now. So I would just, if I was any individual, I would tread carefully and have a lot of consideration and thought when I make a decision in this type of environment. And there's no shame with saying, I want to be risk averse and not take on that risk and maybe sit on the sidelines for a bit longer before I see things stabilize.
Yeah, and one of the challenges when you talk about time horizons with real estate is it's just a lot more illiquid because you can buy and may not be able to sell in 3, 5, 10 years, whatever the time horizon is, given that market circumstances may change. And so that's one of the things that we at Buy Properly have endeavored to solve for by creating an exchange setup where you can actually, when you buy shares, you can list it, trying to solve for the illiquidity that real estate has fundamentally attached to it, because you can't just sell the whole house whenever you want. I mean, I don't think we can claim to say that we have completely solved for the illiquidity problem, but at least we will enable some sellers to be able to sell if circumstances change for them, and let other people who are looking to buy a dip or looking to buy opportunistically buy within that time horizon. With that, it's been a fabulous session, and I am wondering if people have questions for you in this, but this was like, I wish I was taking notes. I was on the webinar, but I wish I was writing this the whole time. Thankfully, we are recording, so I can go back, replay, and maybe I'll replay certain sections a couple of times to make sure I understand all of the dynamics that you have explained. So opening it up to the audience to see if they have any additional questions in this context. Well, I guess not. I don't see anything coming in. So I guess we'll call it a day. We do have another webinar for all of those people who have joined. What's the outlook for buy properly to invest? So we are actively investing, even in the current market. To Nigel's point, we have always believed in fundamentals, and we try and bring in assets that we feel are fundamentally strong, independent of the market circumstances. We usually don't try to ride the market, and the intent is to say, if you have a 5-year horizon and it's a good asset in a good location and does not require a ton of repairs, yes, costs may put pressure on your overall returns, but overall, if the fundamentals are strong, you'll be okay. So nothing is changing in our core principle of what kind of assets will we bring on the platform. What might change is how we structure the financing of it. So while in the past we have tried to bring in debt to increase the overall returns, now we only want to bring in assets that either have interest rates that have a cap or low amount of debt, or if we are doing a single family rental, zero debt, to make sure that we are not overexposed to interest rate changes in a negative manner. So definitely that is what we are trying to do more of. Also trying to diversify out of just Canada. So we obviously have US, but again, US and Canada aren't really very far apart as far as some of these macroeconomic indicators are concerned. But we are also looking to add emerging markets so that there is a little bit of diversity on where the different markets are in their individual real estate and macroeconomic cycles. Yeah, somebody is recommending we should be cash rich and ready to scoop up rental properties at a discounted price. Sure, I mean, yes, I don't know if we are cash rich, but if there are investors looking to buy, we are looking to bring a host of very good deals in the coming weeks, so keep watching out. And we obviously, it's not like this is a surprise that this is coming. This has been talked about. I think even with Nigel, we have discussed this in the past, that this is a possibility, and we have factored this in our thinking that whatever we buy, we will kind of be okay in the stress test as far as we are concerned. There's another question. Oh, never mind. I think it's a compliment, so I'll take that. Thank you, everyone. We do have a session tomorrow that is focused on one specific property. It's in Sugar Land, Texas, near Houston. It's a US property. It's a multi-family, it's a value add. Excuse me. So while in the past we have done more rental properties that we would buy and hold, and that's it. Now, given the current market, we are trying to do more value add, because then there is room to actually change the fundamentals of the asset, and therefore the returns are not driven just by the market going up. The returns are driven by the fact that somebody will do work, and therefore the value would go up. And this is one of those assets. It is from an asset manager that is kind of my personal favorite. But that aside, it is a really good deal with capped interest rates in a market that's doing very well. So join us if people are interested in adding some sugar to their portfolio. Thank you so much, Nigel. This was a very informative session. I know some of the attendees have mentioned that. It was definitely very informative for me. And it kind of summarized all of the chatter, all of the random clickbait titles that I have read through in terms of information. This was a great summary of what it really means and what we should be looking at. Thank you so much.
Thanks for having me. It's great.
Thank you. Thanks, everyone, for joining us. And keep watching our space at Buy Properly for a lot of new good deals that we are bringing in. We've also been slow in the last few months just because the market was so choppy that it was not easy to get a good deal. But we are excited to bring a host of those now. Thanks.